Good evening. Melt up. That's the name of the game. Where we're at, where we're headed. I think we're going to be in this situation until about September 6th or September 18th, which are two very, very key events. And I'll give you a little advance heads up. I'm going to do a deep dive on those events in next week's show. But for now, we got a lot to talk about, especially since I haven't seen you in a couple of weeks. Where were we? Where are we now? How did we get there? We're going to get into all that. My name is Peter Rezicek, and this is the Weekend Edition. As we were discussing in the introduction, I believe we are in the throes of a melt up here that is going to continue. And since I haven't seen you in a couple weeks, I wanted to just revisit some of the important technical action of where we've been since I last spoke to you and how we got to where we are, because I think it's extremely important, especially for newer traders that are just getting their feet wet with TA and really want to take their game up a level to really understand the narrative of how we got here from those lows, which were not that long ago when it seemed like the market was just going to hell in a handbasket and things just kind of turned around out of nowhere. So check this out right here. I want to start with this tweet. This is actually a snapshot of the morning report that I put out every single morning. It's called Peter's Pre-Market Perspective. And I took a snapshot for this tweet. This is actually from Twitter, obviously, but in the tweet I took a snapshot of a piece of the morning report from August 15th. And in it specifically, I said in the scenarios, I always lay out 3 different scenarios of how I believe the day will play out with all the key levels that you need to be looking at essentially. And in this particular scenario, I said in the first one, I said, I believe we are going to melt up now from here to the September 18th FOMC meeting. Pullbacks should be buyable. Why did I say that specifically on the 15th? Let's go over the charts and take a look over here. On this S&P daily, I specifically said that on the 15th because that was the time when the market actually broke trend. Once a market breaks trend and has a daily bar that's closing above a trend line, that is basically the end of the downdraft. You can look at it any way you want, but really that's the end of the downdraft. It's not opinion, it's simply fact. When you connect highs and you move over that line that connects the highs, the downdraft is over. So let's take a look right at that August 15th, which is this bar right here. So that's obvious, right? That at that point, you know, this is why I said I believe we're going to start to melt up from here. And we have just slowly started grinding to the upside, basically. But as I was saying before, what's equally as important is to understand from a technical analysis perspective what happened before that as we were coming off of the lows, where this was the whole yen carry trade situation, right? As people were going back into the yen and selling risk assets, right? That was driving risk assets lower. At that low, there's really nothing going on technically that I could see other than that double bottom in the NDX futures, which I showed you recently. Other than that double bottom in the NDX futures, there really isn't that much going on here that would say, okay, this is a low. So because you're not really just going to buy a low out of nowhere, it's important then to take a look at the candles and see how they are forming once you come off of that low and see if there are clues as to whether or not you are actually going to move forward or retest those lows. And in this case, the market gave lots of clues that it was going to move forward and not come back to the lows. And I'll show you exactly why. So as you came off that low, the important area to notice here really is the consolidation area. And we talked about this area a lot in prior videos. In the video that just came out a couple of weeks ago, this area was very, very important because I was talking about how the market was going to break down below that area and saying that there was a good chance to go much lower from that area if that consolidation area was lost, right? Especially because you had this sort of look above and fail here where you went above the consolidation and went back through. So when you have a technical pivot like that, right? You have a cluster of prices. It's extremely important to carry it forward in your narrative. Just because you had a look above and fail once and then you crash down below the low of it, that area is still important. And it is still an important reference point that you need to remember and carry forward in your narrative. And in this particular sequence of events, I like to call them sequences, in this particular sequence in the market, it really did have a lot of import in showing us that this move in the market off the lows was not going to turn around back to the downside. And I'll show you why. Specifically because as we came off of those lows, right, we retested that area relatively quickly. And in doing so, we also made a 100% retracement of the move once we broke down from the area. That's point number one. That's very, very important. General TA will tell us that when a move gets retraced like this, 100%, the odds of going back down to that low dwindle much, much lower. I think they're very, very close to zero. There's, of course, some chance of it. I mean, obviously a market can just turn around and go back to wherever it wants, but think of that in terms of odds. The market is now telling you that the odds have lessened greatly that you're going to go back down to the lows. After that, it actually gets a little bit more interesting in that if we continue to focus on this area, right, look at what happened to prices soon after. The next bar here was a big body candle that went into the area. It did not resist at all. This is extremely important because it plays into the whole concept of what I like to call WWSHD, which is extremely important, which is when what should happen doesn't. What should have happened here should have been an immediate rejection of that area because there is so much overhead supply from that big consolidation. Prices are fair here. This is value. The market is moving down away from value, rallying back to value. So this is balance. This is excess. The moment you come back into balance, there should be sellers there. The market gave us a very, very strong signal as soon as that candle drove up into the consolidation, telling us those sellers simply weren't there. Okay, so that's point number 2 right there. So now you see how, as you're building this narrative day by day, the case is getting a lot stronger that this action down here is not going to be revisited anytime soon. Let's go over to point number 3 now. Then the market kind of moves up a bit, crawls up here, and it closes here below the trend line, and then notice that the next day in the cash market is a gap, and that gap comes up over the trend line, and that's basically the death knell for the sellers. That's basically it. And the problem is not enough of them know it. They're not paying attention to this stuff. There's definitely people still short. There's definitely people still with negative sentiment about the markets, and the rest is history, basically, right? Since then, we've just had this kind of melting up situation since there where we just slowly climb a bit higher, right? I am a big believer that from here, we will definitely see the all-time highs. I know that's not much of a call at this juncture because we are so close, but I've been bullish from, quite a ways back here. I've been saying that this market is no longer going down. We're going to have moved to the upside. What's going to be very interesting here, or I should say what is especially interesting at this juncture is notice what happened on Thursday when you had the bearish engulfment. That was just yesterday. I'm recording this on Friday the 23rd. Just yesterday was the big bearish engulfment candle that went down hard, however, did not take out the 8 EMA, so it held the first key line of support, and yet look what happened today. Retrace of the whole thing, no retest of that low, and you had a day on Friday closing very close up against that high. So these all-time highs are definitely going to be in play soon, at least in the S&P. The NASDAQ 100, which I'll show you in a moment, is lagging a bit. Now, I'm not going to get into this in depth, but I do believe there are 2 catalysts on the horizon, and the market is moving strongly towards those catalysts, and I believe there is nothing that's going to happen between now and then to derail this, and I think the market will probably hit the all-time high and dribble a bit higher until one of 2 things happen, which are going to be 9.6 and 9.18. The first one being the BLS will put out their labor statistics on the unemployment rate on this day. Again, I don't want to get too deep into it because I'm going to do a deep dive on this next week's video when we get a little bit closer to that date, but this is going to be very important. Right now, this level is sitting at 4.3% of the unemployment rate, and I'm telling you that the world is watching because it's going to have a lot to do with the drumbeat of recession, whether it's happening or not, how deep the cuts are going to be on the 18th, what is going to influence Powell's decision on that. Do we just get a quarter point, which I think the market will be very angry with? Is he going to go a half? A lot of this is going to play in, but most importantly, this number right here is going to be important coming into September 6th because that is going to tell us if the market is indeed going to slide into recession or not. And almost always when the cuts begin, they're usually late, meaning the economy is already in a little bit of a recession, and we should see from that point equity prices potentially move a bit lower. But again, we'll get into that in detail in next week's show. The S&P 500 is indeed the only chart that matters, but we always look at this NASDAQ 100 because I've been saying forever that I think it is the second most important chart. And the only reason I really want to discuss this chart at all today is just to point out the sheer divergence between where prices are now and the all-time high. Just eyeball it. You don't need to take measurement. We don't need to talk about the exact percentage terms, how far away. It's obvious. Tech is definitely lagging here. You can see it in the bars here. Even just on this Friday, where did we close? Closer to the middle of the range, and we just looked at the past chart where the S&P was at the highs. Okay, I don't know if this is going to make it back to the all-time highs before those September events. My gut feeling is that it will not, and if and when the downturn comes, which I believe it will, that we will have one corrective activity before the end of the year, potentially on the market moving events that I just discussed, we shall see. This will lead lower. I believe that tech will make some sort of a lower high and it will lead lower. So just kind of keep that in mind in forward thinking of how you're going to play this. If indeed the scenario plays out as I expect, and there will be some bearish activity within the next, say, month or so, you're probably going to want to hit NQs, QQQ, some of the tech names ahead of some of the other ones because you're seeing that relative strength in the S&P side. And that, by the way, is coming from the rotational aspect of the market that we've been talking about, okay? I'm not going to spend any time going over the charts here, but look at financials, right? Look at some of these other sectors like XLF, et cetera. They look so strong. It's really very, very few sectors that are acting like this. The majority of those 11 sectors are closer to those all-time highs than technology is. And I think that's reflected in the NASDAQ 100. And if we get that move that I'm talking about, as I've been saying, I think this is the place to be looking for shorts rather than in the broader market of the S&P 500. Now we're going to move into what I hope is a more educational aspect of this particular show with the play of the week, especially because the play this week is a losing trade, one that came from my own advisory, the Weekly Options Advisory, and it is on NVIDIA. Let's switch over to this next slide here and we'll show you the trade itself. Lost about 140 bucks, not a very big loss. As you know, the official size in the Weekly Options Advisory is kept small for everybody to participate. I trade much larger size on my own, but in the official call, we were about 4 units and 2 units. And this was what we call a risk reversal, meaning that we buy some sort of a call structure, could be a vertical, could be a butterfly, reverse mullet, unbalanced, whatever, but some sort of a debit call structure because we believe the stock is going higher, and at the same time we sell puts, in this case the 120 puts, to bring in credit to ease the cost of that call side. So let's take a quick look over here on the other chart. I've actually set it up already for us in an annotated manner with the trades underneath so that we can go over it piece by piece. And I think this is going to be very, very educational to see how I manage option trades from start to finish in the event that the price action actually doesn't go the way I expected. And this is exactly what happened here in NVIDIA. So you'll notice that this is an NVIDIA daily chart, and I've purposely marked off 1, 2, 3, and 4, which are the 4 action points that happened in the particular trade. So let's go them. And they're going to correspond right here with the trades that you see here on the bottom of the screen. So the first thing that was done, which was August 19th, was the purchase of the August 23rd series, so it's right in the same week, these are weekly options, purchase of the 130, 135, 140 call butterfly. Pretty simple setup, right? Paid a debit for it. That cost 91 cents, bought it 4 times, so you can see the debit here is about $364. And why did I do that? Did that for a couple of reasons. One, this was the day here that the stock broke out over trend and it closed over the downtrend. So my thought process is that it is now going higher and the all-time high up here, up in the 140 area, is going to be in play. So in order to capture some portion of that move, I'm thinking about using a butterfly here of 130, 135, 140. The selection of this particular structure as opposed to a vertical or a long call is very, very important. And you don't see it here, but when I alerted people in real time with the cut and paste of the fill on the butterfly, I specifically said to my subscribers, I said, I'm going with this structure because we're a little bit late. And the fact is we were a little bit late in that we didn't do it right on the trend line break. We were closer to the end of the day. And so my thought was, when you're late, you want to do something that is normally cheaper just by the way that it's structured, meaning butterflies are always cheaper than verticals and certainly cheaper than single options. So I was thinking of the butterfly in this sense. And because the market closed so strong here at 0.1, you can see right at the top, I'm not thinking about selling any puts just yet because it doesn't make sense when the market is very strong and the stock closes right up on the high of the day, right? So you don't want to be a put seller then. You want to wait a little bit, which brings me to point number 2, right? At point number 2, which is the next day where you had a pullback right to the backside of that trend line, what did we do? We actually sold some puts here. That brought in $136 of credit. We sold the 120 puts. Why did we sell the 120 puts? Pretty simple, right? You see your 8 EMA here is at 123. At the time in here, it was right around just above 120 at that time. So I was picking a spot just below, okay? So far, everything's okay. We've brought the cost of the call side down by about a solid third, right? But here's where things start to get squirrely, because then Thursday happens, which is the big liquidation break here at point number 3, and it actually closes a little bit low. So now I have a decision to make, because now there's potential for these puts that I sold relatively cheaply for 34 cents. They've now exploded in value against me, and there's potential that if the market decides that it actually wants to move a bit lower, which anything can happen, even though I'm generally bullish here, I need to protect myself. So in that case, what we do is we then buy some protection in here, which is the 118 puts. And this is also quite educational, because think about it. If I've got puts short at 120, the market is, 120, correct, and the market is closing somewhere around 123. I have a lot of different choices I can make. I can buy a vertical and push those puts lower. That's going to cost me a debit. I could buy a put in front of the puts to create a long vertical. That's going to be quite expensive. I could buy the puts back, right? So in this case, I weigh all of those different choices, and I decided maybe the best course of action is to spend as little debit as possible and buy some 118. So you can see right in here, I spend about $136 buying 118 puts, turning those short 120s naked into 120, 118 put verticals, so that if the market decides that it's going to fall out of bed the next day, or if there's some overnight news, whatever, I'm not going to be that much at risk, because now I'm just holding this relatively narrow put vertical as opposed to a naked put at 120. All right. After that, what happens? That brings us into Friday. Market rallies. Obviously, the puts go out all worthless, so I lose the amount of money or the hedge. But also, here's where things get interesting. Now, remember, I'm long the 135, 140. Or the 130, 135, 140, excuse me, butterfly. So I've got a long call at 130, and you can see the price action right here on Friday went pretty close to the 130 level. Just about got there just a little bit. So as we were rallying early in the day, and this is also very, very important, and I hope that newer options traders take this to heart. When you're in a situation that you have debit and you need to get back that debit, and your time is measured in hours rather than days, right? It's expiring that day. You need to do everything you can to get that debit back, meaning that if the market starts moving towards your spread, don't sit there and say, oh, now I'm going to make a profit. Flip your mindset into thinking, oh, now I'm going to do everything I can to break even or make this the smallest loss I can, because in effect, the price action that I expected from the stock, which is what I thought that we would just continue to climb up to those highs, didn't happen, right? This is what I call a good loss as opposed to a bad loss, because a good loss is where you read the chart correctly, but then the stock just does nothing and you kind of run out of time in the options game, right? So you've got options just expiring and it doesn't really happen for you. So that's what happened in this case. So long story short, at point number 4 here, right, which is on Friday morning, which is today, as we moved closer and closer to that 130, I'm already selling those spreads, and I'm, instead of selling them as butterflies, which are harder to fill because often on that day of expiry, that top strike may not have any bids, so the market makers, it's going to be difficult. You know, they're not going to want to fill that butterfly because you're going to be trying to sell a zero bid call. It's better to do it as a back spread, and that simply is just this, is that you just do -1 +2, and in this case, right, I just used the 130, 135, and these two that I'm buying back at 135 are like 3 cents or something, so they're not taking it down much. Long story short, I needed that spread here to get up to 87 cents to break even, but the best I was able to do was about 61 or 62 cents. So in the early morning strength, before the market fell apart and had a big pullback midday, which we know it did on Friday, there was a huge liquidation break. I was able to get out of those, and then net, the whole thing closed for a relatively small loss of $140. So I hope that's helpful to you. This is a classic example of how to manage a relatively complex options trades that has both sides to it. Again, I call that risk reversal. You have a call side and you have a put side, and the market is essentially not doing what you expect. So I hope that you take a little bit of educational import from this in terms of how I manage the spreads on a day-to-day basis in real time as the market is moving. And remember, anytime you guys want to hang out and trade with me, see how I do this live in real time, just hit the link in the description below. I'd love to see you in the room. In as much as the last segment was a look back, this segment is a look forward, which is really what we always want to be doing on this program, is looking forward and talking about ideas that we can utilize for the future. So in this case, we're going to do a Should I Do This Trade segment on Meta this week, which comes to us from a gentleman named Scoot Luke, who is a member of my weekly options advisory, and he sent this in earlier this week. His idea was to buy some butterflies on Meta going out to next week, August 30th, using the strikes 555, 570, 600. So right off the bat, you should know it is a broken wing butterfly, so it's a little bit cheaper because the distance between 555 and 570 is only 25. Or rather 15 points, 15 points, and then you have a 30-point distance between 570 and 600. So that difference makes it a broken wing butterfly, makes it a bit cheaper. Paying $1.41 and using some short 500 puts in the same expiry at 89 cents to pay for it. Let's take a look at the chart here and see why I believe that this actually is a trade that should be done, and I think it makes a lot of sense. Pretty bullish chart on Meta. Today's action notwithstanding, I totally get it, did not show a lot of relative strength. Actually, stock kind of went straight down as the market was moving higher, so that is a factor. It does have an 8 EMA here that it's finding some support at. But just to recap, the idea is buying here the 555 puts, right, and selling 2 times the 570s. That 600 on the top, by the way, is just for margin. That just makes the spread cheaper. So essentially what you're doing is just financing that 555 call with the 570s. That's costing a debit, and then selling 500 puts to pay for it. And this one actually turned out to be almost cost even, basically cost equal, like a cost push, basically, that there's not a lot of debit in the trade, which is good, meaning that unlike the NVIDIA trade, if this goes nowhere, as long as the stock remains over 500, it should be fine. Why are the 500 puts smart to be selling? I've put the fib here from this move down to the move up, and notice that that's the exact midpoint right here. About 497.57 currently is the midpoint. So our bet is basically that even on a downdraft in Meta, which I don't believe is going to happen here because it should follow along with what the market is doing, there will be some support coming in either at the 500 or below it. So we're short the puts here at 500 to pay for the trade. And again, it needs to get a little bit higher to break out here and move up. It is kind of a little bit to ask of the stock now, given after the Friday situation, but I would not be adjusting this trade in any way, shape, or form as of now, given that there's plenty of time for this to work out. And when the stock does get moving to the upside, you can see some of the average true ranges here, or some of the ranges, I should say, that the stock has been doing recently. It's not that difficult for it to move up to that level. And that mid strike also is there for a specific reason, because it is tying in with, there's a channel here, right? There's a channel high here. If I made the chart smaller, like on a weekly, you could see it, but obviously there's a channel high there at 570. So it's always smart to be targeting that channel area with the mid strike of your spread. And if you can see some sort of short put action at a specific technical level that you can sell to ease the cost of that trade, it always makes sense to me. That's the way I like to trade from the long side. So free month of weekly options advisory coming to Scoot Luke. Congratulations on that. Be watching your inbox. And remember, you can always email me at asktheshadow@shadowtrader.net each week. Usually around Tuesday or Wednesday is the best time. Just put "should I do this trade" into the subject line. And if I use your trade in the program here, you'll get a free month of the advisory as well. Looking forward once again this week, the #1 draft pick is Chipotle. This one's actually kind of interesting because it actually comes from one of our team members internally. It is Brad Agunis, who has been with us for a long time. He is one of the moderators in the live trading suite in the stocks and options room. Remember, that live trading suite is split into 2 rooms now, which is really exciting. We've got a stocks and options room and a futures room. One subscription price gets you both rooms, which is great. And in this particular CMG setup comes to us from Brad because it was a recent Shadow Shorts video that he did. And I purposely wanted to show you this home screen of our website. If you're not receiving the Shadow Shorts videos from myself and the rest of our team members on a nightly basis, they come out 5 nights a week between Sunday and Thursday. I highly recommend that you put your email address here on our homepage and be getting them via email every evening. So recently, earlier in this week, Brad put out this video called CMG Back in the Burrito. And this is actually, I think he named it that specifically because I know he was short the name and he was doing pretty good with that. And then he flipped to the long side recently, which I 100% agree with. And I think this actually could be something that's going to be in play for a little bit while longer. So let's take a look over here at the chart of CMG. This is on a daily where I've got it going pretty far back a bit here so you can see more of the chart to show where we are in relation to the all-time high, how much we've come off a bit here. Obviously, the price is a lot lower than some of you may be accustomed to because of the fact that there was a big stock split in the name. So that's why you're seeing a $53 stock price as opposed to one that's 4 digits. But a couple of things happening here technically on the chart that I think are very, very noteworthy. First one being that you've got this movement here on the downside that was an almost perfect double bottom on a big increase in volume here, right? Where the stock fell precipitously and sold off down to this low and basically made an equal low right here. Right off the bat, that sort of gets me interested. Whenever I see something like that, I carry it forward in my narrative and I take it from there and see what's up. There's one downtrend line here, and this downtrend line is actually interesting because it was broken already, but then you had this failure, right? So you had this failure down, double bottom, and then you got this slow climb back, and now you've set up another trend line here, which is just now breaking. Basically, I think the play in Chipotle is this, is that it is long, and the reason that it's long is because technically you've got the double bottom, you already broke trend once, then failed, now you're climbing back and breaking trend again. This speaks to me in a manner of saying basically that sellers are being constantly frustrated in this name. They're making money on the downside here, then they're getting hosed, right? They think they're doing okay because they got this gap down that rallies like crazy, right? Here, they think they're doing okay again. It just keeps frustrating. And little by little, I think they're going to get more frustrated. And what that does, it just kind of leads to like the slow grind higher. Now, obviously, the broad market is going to have a lot to do with this. Stock needs to stay strong. If those drum beats of recession that I was alluding to earlier that will probably hurt stocks like this, which are people's discretionary income. So obviously there's some caveats here. I'm a big believer that you don't want to be playing any stocks unless the market is going in the same direction. So keep that in mind. But in the near term, I do believe that this should dribble higher here because now you have actually broken trend. All the other technical stuff is here. And of course, the biggest factor here is that the sellers are just getting more and more disappointed as the stock is no longer bearish from a technical standpoint. And that's my show for this week. Thank you for spending a little bit of your weekend with me. If you could, please hit the like and subscribe buttons on the video and also the little bell icon so you get notified whenever Shadow Trader posts new videos such as this one or the Shadow Shorts videos that my team puts out every single night. From a technical basis, market is obviously bullish. We're melting up. I believe we will continue to melt up at least up until those two catalysts that are around the corner. We're going to do a deeper dive on both of those next week in our Weekend Edition show, talking a little bit more about that BLS release about the unemployment rate on September 6th and also the Fed meeting that's happening on the 18th, where, as it was reiterated today at least by at the Jackson Hole, I should say, by Jerome Powell, the cuts are on the table. The question is going to be how much we get and what the press conference is going to sound like in terms of how much are we getting further on, et cetera. So we'll see if the market likes it or doesn't. All right. Until then, I'm Peter Rezenchek from ShadowTrader.net. I wish you good trading and good night.